Coming up on Market to Market, government reports get big reactions from commodity traders. Grain farmers continue their battle against Mother Nature to finish planting. And the Greek meltdown ripples through Wall Street. Those stories and market analysis with Virgil Robinson and Walt Hackney next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, July 3 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Consumers are headed back to the stores, despite the fact that fewer Americans were looking for work. U.S. employers added 223,000 jobs in June, dropping the unemployment rate to 5.3%, the lowest level in 7 years. However, the Labor Department notes many people have given up looking for work and therefore aren't counted among the unemployed. The Dow plunged Monday on news of the unstable Greek economy, but rallied on word the country is willing to negotiate in order to remain in the Eurozone. However, the Dow closed Thursday on a down note. Consumer confidence topped the century mark in June, supporting the view that strong job gains are giving a boost to the overall economy. And crude oil supplies increased for the first time in 9 weeks, with prices closing on Thursday in negative territory. Those traveling by car this holiday weekend will have a little extra change as the price of a gallon of gas fell below $3, the lowest rate since 2012. And government reports from the Agriculture Department added fuel to the fire in already volatile grain markets. The USDA released its acreage and quarterly grain stocks reports this week. The most recent estimate punched a hole in more than a few records. According to USDA officials, U.S. farmers planted an estimated 88.9 million corn acres, down 2% from last year and the smallest number since 2010. Soybean acreage was guesstimated at a record 85.14 million acres, less than 1% higher than the recent prospective plantings report and 2% over last year's record. Wheat was estimated at 56.1 million acres, up 1% from the March report, but down 1% from 2014. Weather played a big part in acreage reductions for corn and soybeans. According to the USDA, wet conditions in Kansas and Missouri have slowed planting when compared to the 5-year average. The sunflower state is 42% off the pace, and the Show Me state fell behind by 34%. Overall, the corn crop is 68% good to excellent, down 3 percentage points from last week and 7 points lower than last year. The 18 states that grow the bulk of the soybeans are reporting 63% of the crop is in good to excellent condition, which is down 2 percentage points from the previous week and 8 points lower than 12 months ago at this time. U.S. corn ending stocks came in at 4.45 billion bushels, up 15% from last year. Despite the increase, 3.3 billion bushels have been used, nearly 4.5% above last year's 3.2 billion bushel figure. The report showed soybean stocks at 625 million bushels. Disappearance of the oil seed between March and May totaled 701 million bushels, up 19% from last season. Old crop wheat stocks were estimated at 753 million bushels, up 28% over a year ago. The news shocked the bears off the futures wire and ran them out of the options pits for a record day in Chicago. In the follow-up session, prices fell back as some of the profits were taken off the top. The lack of water is creating more trouble in the tinder dry West. The amount of land charred by wildfires doubled this week, topping the 2 million acre mark. Some of the most dramatic images came from Washington. Several homes in the central portion of the Evergreen state were destroyed as several square miles burned. The Pacific Northwest continues to be locked in severe drought, along with much of the West Coast. Some residents in California are responding to mandatory water cutbacks. Regulators say cities cut their use of the precious resource by 29% in May as compared to 2 years ago before reductions were ordered. But back in the heartland, most of the floodwaters from last week's deluge have receded, leaving behind a muddy mess.
Next, the market-to-market report.
The weather report is dominating the commodity markets in this holiday-shortened week. We are producing this program on Thursday as the markets were closed Friday in observance of July 4th. For the week, September wheat broke the $6 threshold before settling with a 23-cent gain, while the nearby corn contract has improved nearly 20% in the last 3 weeks to finish 36 cents higher. Soybeans stayed above $10 for a 40-cent improvement. Nearby meal prices followed suit with a rally of more than $15 per ton. In the softs, December cotton declined 12 cents per hundredweight. Over in the dairy parlor, July Class 3 milk futures lost 8 cents. The livestock sector reversed course as the August cattle contract rose $2.70. Nearby feeders eked out a 20-cent gain, and the August lean hog contract improved by $3.50. In the currency markets, the U.S. dollar index gained nearly 1%. As of the close on Thursday, crude oil decreased again this week, down $2.70 per barrel. COMEX gold continued its downward trend with a $9 per ounce loss, and the Goldman Sachs commodity index declined almost 3 points to settle at 432.85. Here now to lend us their insight on these and other trends are two of our regular market analysts, Virgil Robinson and Walt Hackney.
Mike.
Gentlemen,
Hello, Mike.
Welcome back.
See you, Mike. Thank you, Mike.
Well, we're glad to have you. It's an interesting week to have a couple of great minds on the program here. And Virgil, would you talk us through the move this week in the wheat markets? Let's start there. Was there anything on the report that really spiked that market?
No, I think at face value, the reports were actually neutral to bearish, Mike. But of course, the price explosion in corn futures and other coarse grains lent support, in addition to, I think, a conversation about deteriorating conditions in parts of Western Europe, parts of Australia, parts of Canada, and a quality issue here in the U.S. So those, I think, combined, Mike, to provide the spike in price for wheat futures. However, with that spike came a pretty significant movement of really all three varieties of wheat, old crop as well as 2016 new crop, Mike. So again, I think producers are paying close attention to the marketplace, having their offers above the market, and in this instance, I think it paid dividends for them.
So there was a lot of movement, farmers selling on all three of those varieties.
The way I track movement in wheat, corn, and soybeans, this was one of the most active weeks of cash grain sales seen in a considerably long time.
Now, as we look back over the past really 2-3 months, one of the major variables in the wheat market has been that U.S. dollar. Have we gotten over that as a psychological issue here in the wheat market, do you think?
No, I don't think so, because again, it seems each tender that is publicly rolled out, we are second fiddle. Egypt, probably our best wheat customer for the last many years, continues to source their product from other origins, not U.S. So I think the dollar plus what we're asking for our wheat on a FOB basis prevents us from making appreciable new sales, Mike.
But does that deteriorating crop elsewhere in the world bode well for U.S. wheat sales, or is our crop deteriorating at the same rate as we're seeing in Western Europe and Australia?
We'll get some insights to both of those questions next Friday with the next WASDE report. I think, again, they'll be obligated to address some of the concerns that we've just identified.
All right. All that being said, the trend we're in today is up. Does that trend look like that should continue to your mind, or is this just a pop?
In wheat?
In wheat.
Mike, I think there's the possibility of additional gain, particularly if the other coarse grain commodities continue to move irregularly higher. It will lend some support. But to suggest we have another dollar plus move in wheat in a short period of time, I would be very skeptical of that.
Okay.
I think this spike in price created a good selling opportunity for those that are lugging inventory and those that are planning on growing wheat in the next crop season. I think in both instances, cash grain market behavior would suggest producers sold both.
That's right. prudent risk management.
I think it is.
Well, now, as we're talking about coarse grains, we saw the big move this week really were corn and soybeans, with corn being the really an incredible story. Talk us through, again, the report. What was your take on both the acreage and the quarterly stocks report for the corn market?
Well, again, I think both fell below market expectations. And first of all, that provided the shock that created the start of the run in the futures market. Add to that the concern. We've had 3 consecutive crop condition reports where the sum of good and excellent corn in the U.S. has declined. And there are areas of concern, Mike, and I'll try and name a few of them: parts of Nebraska, clearly Missouri, Indiana, and Ohio. It's just flat been too wet in a lot of those regions, and the crop is struggling as a result of that. So, you know, we've a couple of moving targets here, trying to define acres and then clearly trying to define yield. And that's going to be difficult to do, I think, over the course of the next many weeks, given the kind of season we've had. It reminds me a lot of 93 and 2001, where we just could not define with any degree of accuracy until September, when the harvest began, what kind of production, what kind of crop we really have.
Okay. Now, looking at the old crop situation, this week, I know just as we track movement, I was watching basis locally in central Iowa, and there was some pretty substantial weakening of basis, which implied that there was a lot of farmer selling going on. Is that what you saw nationwide?
It is. I think there was a major movement of cash grain, both old crop and new. And in that context, I think there's been some modest pricing of the 2016 crop. So again, those who are paying attention to their balance sheets, their objectives, I think they're going ahead and employing the strategies necessary to capture some money here, make some money. You know, a few short weeks ago, we were real concerned about a lot of people not even being able to break even. Okay, so this market has provided, I think, an opportunity for them to address that concern.
Okay, now, Walt, I want to talk to you. Last time we had you on and we were talking about these crazy feeder cattle markets, you'd mentioned that one of the reasons you believed folks were willing to bid so aggressively on feeders was all the old crop corn stored on farmers' bins. Given this movement, is that going to have an impact in profitability for feeder cattle producers or hog producers trying to buy that corn out of farmers' hands?
I think it changed some of the attitude of some of the potential buyers that we had prior to this issue of there being some liquidation of that on-farm storage. The attitude at that time was they were maybe facing the need to feed and then feed more and more of that on-farm stored product. Now they have that luxury of a little more independence, and they can maybe go to the cash market with that corn now, and they can go ahead, but they're making more rational decisions on buying the cattle to go into it. And with that having been said, it has not deteriorated the cash market on cattle, nor has it particularly lessened the demand for cash cattle. But what it has done, it has furnished the potential buyer that independence of making an alternate decision on whether to feed it or sell it.
All right.
And there's a lot more comfort among the buyers today than there was. You of all people would understand the attitude of being forced to sit there and feed that bin of corn that you've saved. Now you've got the luxury of helping your own cash flow needs at the farm, like Virgil's talking.
Right.
It improved the balance sheet of a lot of these cattle feeders without having had actually bought any cattle.
That's right. You don't necessarily have to walk it off. Now you can truck it off and catch a little bit of a premium.
Exactly. Now,
as you look ahead to the new crop, like you mentioned, probably not going to have a good handle really on yield or production, perhaps until September if we don't get any clear signs. That being said, for producers who have been hesitant in making some risk managing forward sales. Does this rally give you enough confidence, Virgil, that maybe now we should start to pull the trigger, or do you think there's enough indication of this thing moving forward?
Well, if they've done little or nothing, I think this is an opportunity to begin, Mike. And as mentioned this past week, there was a lot of grain sold from farmer to commercial elevator, country elevator. So I think they've addressed that issue to some extent. The term gambling bushels, often enters into a conversation the likes of this. And I think those who are down to their gambling bushels, and those bushels were retained primarily because of weather concerns. We haven't eliminated the weather concerns by any stretch of the imagination. That's an ongoing process for the next several weeks. So I think they will probably retain those inventories until deeper into the crop season, Mike.
Okay, now we're talking weather issues. It's been the talk every Monday as that crop conditions report comes out. Soybeans being the big sufferers if you're in Missouri, Kansas, Arkansas, or the big beneficiaries if you're growing beans elsewhere of this weather scare. Talk to us about what you're seeing as far as weather concerns. How honestly should we be taking these concern thoughts?
Well, I think NASS addressed that by stating they will resurvey Kansas, Arkansas, and Missouri regarding planted soybean acres. The same with regards to milo, sorghum in Kansas. They're going to resurvey their farmer base to update data if need be, and cotton in Texas. So the weather clearly is concerned to the extent a resurvey will take place at least in those aforementioned states. So that perhaps defines the concern regarding weather.
Now, the other thing that struck me as surprising on that report was the quarter's demand for soybeans, 701 million bushels, fourth highest quarterly demand, I believe, in history, at least recent history. Was that just a function of cheap beans? Do we expect that to change here in the next quarter?
Mike, I think it's been well discussed that many were of the opinion that last year's soybean crop was overestimated. And this data, at least the seed and residual part of the line item in the balance sheet, I think underscores that genuine concern. But as importantly, I think you need to understand, and we need to understand, that processing margins in beans have been exceptionally strong for months, and they remain strong tonight. So if the processor can in fact buy your old crop beans, he or she has the opportunity to immediately turn around and sell the co-product, the byproduct, and make a nice margin. And they'll continue to keep capacities running high as long as that's the economics warrant it. And then secondly, while we did see an old crop soybean sale canceled this week in the export sales report, up until this week they've been surprisingly strong. So a combination of good consumption and perhaps a smaller bean crop than what the USDA led us to believe here the last several months.
All right. Now, I want to talk just briefly about cotton. You mentioned resurveying cotton acres in Texas. We saw a 12-cent move to the downside this week. Do you expect cotton to remain relatively stable? How do international supply and demand features look?
You know, I do. Interestingly enough, we were all concerned about the El Nino effect in a couple of regions, cotton-growing regions, one being India, the second being Australia. The Indian monsoon through the month of June, believe it or not, was at or above normal. So the Indians, I think, are on track to produce another large crop of cotton. The Chinese probably are the wild card here. As it has been decided, they will try and reduce the huge in-country reserve that they currently own. Now, the problem is their ownership price is pretty high in relationship to today's international market. So it is conceivable they pass that offering and look to international suppliers because of the price differential. So I think, long story short here, Mike, cotton supplies are adequate as we visit tonight. I think old crop cotton at 70 cents or higher is a very good sale. New crop cotton, that 75-cent area or thereabouts, which is currently above today's market value, is where I would certainly make sales or minimum price sales.
All right. Well, now I want to talk about this meat market. We've already talked wheat. Now it's time to talk meat. Walt Hackney, as you look at this live cattle market, it has been truly a roller coaster for really the past year, but lately in the past few weeks, there has been a lot of divergence between cash price and the board, and it's been a lot more up and down than it has been. What are your thoughts on that almost weekly change in cash cattle price?
It's been said here on your program, Mike, that risk management is paramount at these levels of product prices. Yet, when you go into the livestock end of it, and specifically into the cattle, risk management is nearly an impossible altitude that you can reach for, but you're not going to hit it. The break even on a lot of these yearlings that are coming out now for immediate delivery that would be finished in 5 months or something similar down the road, the break even on a lot of those cattle is up there around $1.60, $1.70. There is no place in the contracts for risk management to offset unless you want to minimize your losses. Now, that's an old adage that was carried forward by a lot of cattle feeders that had more cash than good sense, and it still is one of the attitude prompters out there for risk management. A lot of cattle feeders today will say, well, I'm going to go to a option program. I'm going to build a program of risk management in options. At the time then, when the contracts become applicable, I'm going to then drop out and replace over on the contract side. Then they look at the premiums that's required to set up their option programs, and that raises their break even about another $5 a hundredweight on their cattle. So all in all, risk management is not a workable program right now. And so a lot of the cattlemen that I do work with always will say to me, Walt, tell me when you could buy a feeder animal that would hedge at the day you bought him. And you have to think back, and there's been relatively few times that could ever happen. Maybe this is one of them. I have cattle feeders today that are willing buyers of feeder cattle at this market, indicating that we very easily are going to see $1.60 fed cattle again in the cash markets soon. They're also indicative of the fact that we're going to see, instead of the $2.40 and $50 dollars per hundred of these feeder calves for October delivery, they're still very convinced that could easily go to $300.
Wow.
So when you got that attitude out there, there isn't a lot to stop the market, specifically because we haven't got the volume available. The numbers aren't there to flood a market. There's no fear of overproduction. There isn't any extraordinary numbers of feeder cattle anywhere in the country.
They're just not there.
The availability of feeders coming off of grass, as usual in the summer, on a year like we've had the last 3 or 4 years, that isn't going to happen this year, because the ranchers have taken heifer cattle and replaced that acreage that they normally would have reserved to run yearlings on summer pasture, and they're putting their herd replacement stock out on their own available grass, so there's a shortage of yearlings.
High prices curing high prices as they grow the herd. Exactly. Now, Walt, I want to just take a quick look at the hog market. We saw a $3.50 move this week. What's happening in the hog market here as you look to the next 6 weeks?
Well, you'd almost need to drop back to the attitude of the industry 6 months ago, maybe 7 months ago, but more importantly, when the PED issue was paramount all over the country, and they were looking at a 10% reduction in the pig crop farrowing because of death losses. Somewhere in the economics of those calculations, they misfired. And we are not going to come into this year with the death loss factor, and so we had a bear market coming into this year. So those that were going into expansion helter-skelter back in the fall of 2014, all of a sudden are sitting there like a deer in the headlights, wondering why did they invest so rapidly in that expansion. Today, it's a total abrupt turnaround. The numbers are not going to harm any markets. We are possibly going to see an appreciation of the cash market going into the fall.
All right. Well, thank you so much, Walt Hackney, Virgil Robinson, for joining us. We'll discuss hogs more in our Market Plus segment. But that wraps up this edition of Market to Market. Virgil, Walt, and I will continue our discussion. As I mentioned, we will answer your questions in our Market Plus segment, available only on our website. You'll also find audio podcasts as well as streaming video of our program exclusively at the Market to Market website. And a final note about the program and the people that bring it to you each week. This marks the final broadcast with John Nichols at the helm. Nick, as he's called here at Iowa Public Television, walked in the door 35 years ago, starting on the camera crew. He moved into a producer role on the program and traveled from Arizona to Maine and all points in between, working his way up to the top spot on this program. After 11 years as executive producer, Mr. Nichols is retiring. All of us here want to wish John well in the next chapter of his life and acknowledge his contribution as a valuable resource to generations of viewers across rural America through his work on this show. Thank you, John. And don't forget to write. So until next time, thanks for watching. I'm Mike Pearson, and have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.